Nigeria November inflation just out rose for the third straight month to 34.6%, up from 33.9% in October. Food inflation also surged sharply to 39.93%. The core inflation up to a fresh all-time high of 28.75%. On a monthly basis, the index rose by 2.64% in November 2024, the same pace as in the prior month. We feature in today's 2024 business recap a closer look at Europe, where Lagarde's latest ECB briefing paints an uncertain terrain with trade war and geopolitics threatening supply chains. On Wednesday, we look at the U.S. economy, focusing on the December 2024 Fed dot plot and summary of economic projections. We also expect a rate cut from the U.S. Fed FOMC. That's on Wednesday. Bank of England and Bank of Japan expected to hold rates on Thursday. Hello and welcome to another episode of Global Business Insights, where we bring perspectives and analysis diving deeper into the headlines. The Eurozone Manufacturing Purchasing Managers Index PMI stayed unchanged in contraction at 45.2. That's a December flash. Services PMI expanded to 51.4 from 49.5 in November, also reaching a 2-month high. The pound sterling spiked up as UKS and PMI data showed that overall business activity expanded at 50.5, helped by the services sector, which expanded at a faster pace to 51.4 from the estimates of 51.0. This more than offset deeper contraction in factory activity to 47.3 from 48.0 in November. That's manufacturing PMI in the UK. Respondents also remain concerned over fragile consumer confidence, tighter corporate budgets, and cutbacks to non-essential spending, noting that total staffing numbers were down for the third month in a row. In India, the Services Purchasing Managers Index rose to 60.8 from 58.4 in November, while the Manufacturing PMI improved to 57.4 in December from 56.5 in the previous month. That boosted the Composite Index to 60.7 this month, also the highest reading since August. Japan's factory activity shrank for the 6th straight month on lackluster demand, while the service sector extended gains in December. The Jibun Bank Flash Japan manufacturing PMI sank deeper into contraction to 49.5 in December from 49.0 in November. And in China, retail sales rose 3% from a year earlier, down from a 4.8% increase in October and from the 3.5% in the January to November period. Factory output rose 5.4%, nearly the same as last month, while investment in fixed assets like factories slowed. Still today, Moody's rating said it had raised China's 2025 GDP growth forecast to 4.2% from 4% as it now sees improved credit conditions. It also sees stimulus efforts to mitigate some impact from potentially higher US tariffs coming to play. On Friday, UK GDP slipped 0.1% following a 0.1% contraction the previous month, with analysts now seeing an increasingly likely Q4 contraction. This is as the Bank of England also said consumers expect prices in the shops to rise 3% over the next year, the first pickup in expectations over a year. The UK government has cleared the sale of Royal Mail's parent company to a Czech billionaire for £3.6 billion. That's to Daniel Kretinsky's EP Group. The government will retain a so-called golden share, requiring it to approve any major changes to Royal Mail's ownership, headquarter location, and tax residency. Manufacturers' confidence in the UK economy fell at the sharpest rate since the start of the COVID-19 pandemic, in another setback for the Finance Chancellor Rachel Reeves. Confidence fell to 5.8 in the final quarter from 6.8, the largest quarter-on-quarter drop since 2020. As the UK looks for new catalysts for growth, on Sunday, Britain became the first European nation to join an Indo-Pacific Trade Bloc, the Comprehensive and Progressive Agreement for Trans-Pacific Partnership signed in 2023, and which brings benefits to UK food and drink, automotive and financial services exporters, also attaches the UK to the fastest growing region in the world. Nigerians are hopeful that early wins in terms of economic reform will evolve into a broader economic rebound, but with inflation just announced rising to 34.6%, up from 33.9% in October, it is still complicated. Month-on-month inflation, however, stabilized at 2.64%. That's a good sign of some handle on prices. Analysts have raised issues such as fiscal indiscipline with lavish deficit spend, untidy fuel price hikes, and still unaddressed supply chain challenges, all making restrictive monetary policy of little effect. Recent floods in the food-producing areas also contributed to the uptick. The Nigeria rebound trajectory is moving from a quick win and reform conceptualization phase to the more difficult reform implementation and more micro-process reengineering execution phase. 2024 saw attempts at fundamental changes like the tax reform bill as the economy shifts from consumption and distribution to an economy focused on production. Subsidy removal, downstream deregulation were challenging, which explains why previous governments did not take them on. The government has to be congratulated for their boldness. The legacy that was inherited was difficult, and reversing the momentum of decay needed time to fix many of the fundamental issues. If the attitude remains that of remaining consistent and steady with advancing improved policies, focusing on progress towards much higher goals and avoiding the shortcuts such as propaganda that we are aware we have not yet reached, the thinking is that the dissatisfaction with status quo and case for change should drive even more urgency to do things better in 2025. I would focus on cost of governance and reform execution, and of course ending the inflation plague, which can allow the beginning of a longer-awaited easing cycle. By this time next year, the rebound in the economic trajectory should be much more evident in Nigeria. If we had to find a word to recap the business and economic environment in the Eurozone, that word would be sluggish. Analysts see European Central Bank policymakers announcing more interest rate cuts as investors bet on more than 100 basis points of further easing. This was as Madame Lagarde announced as expected a 25 basis points cut at the last Thursday MPC meeting. Understandably concerned about the dire economic outlook, the decision was taken to lower borrowing costs for the fourth time this year and the third meeting in a row. The removal of language about keeping monetary policy restrictive suggests more moves in the deposit rate are likely in 2025, and policymakers are expected to cut rates by another quarter point in January and probably also in March. Even before factoring a possible drag from Donald Trump's US trade policy, political upheaval in Germany, France, South Korea, and Syria, the ECB had lowered its forecasts for growth in the region, predicting just 1.1% for next year. The latest Eurozone data on Friday, after the ECB meeting, showed zero growth in Eurozone industrial production. Also, gloomy 2025 projections from the Bundesbank does signal that the economic bloc will need a fresh catalyst to avert a difficult stagflation from being embedded. The exact pace and number of further interest rate reductions by the ECB depends on how inflation aligns with projections and other developments in the euro area economy. Some of these issues were covered in Lagarde's speech. A clip of the address is presented.
The risk of greater friction in global trade could weigh on euro area growth by dampening exports and weakening the global economy. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by geopolitical risks such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could disrupt energy supplies and global trade. Growth could also be lower if the lagged effects of monetary policy tightening last longer than expected. It could be higher if easier financing conditions and falling inflation allow domestic consumption and investment to rebound faster. Inflation could turn out higher if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. By contrast, inflation may surprise on the downside if low confidence and concerns about geopolitical events prevent consumption and investment from recovering as fast as expected, if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Greater friction in global trade would make the euro area inflation outlook more uncertain. So, in conclusion, the Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. The first one about trade. I've given my views very extensively in a recent Financial Times interview, and I continue to think that restrictions on trade, protectionist measures are not conducive to growth and ultimately have an impact on inflation that is largely uncertain. In the short term, it's probably net inflationary, probable, but the overall impact on inflation is uncertain because it is going to depend on the scope of the measures, on the retaliation that is decided, on the rerouting of trade traffic from other parts of the world. And that is a very complex situation with movable parts, which we will determine if and when they come.
Asia-Pacific markets were mostly lower, reversing earlier gains as we got weak retail sales data from China. Also in focus, several major central bank decisions due this week, including the Bank of Japan, People's Bank of China, the US Fed Reserve's decision on December 18 will also be top of mind for investors. Well, that's it on this episode of Global Business Insights. Thanks for sharing on Facebook, LinkedIn, and YouTube X. And again, thank you so very much for watching. This is Bode Shosan. Bye-bye.